my view generally has been, certainly from the standpoint of equities, is that it's less about the timing and the number of rate cuts as it is the fact that rates are going down rather than up. Risk appetite and the demand for high risk things, whether it's a Bitcoin or Nvidia or whatever, um, is not necessarily as tied to interest rates and easy money as people think. Gold is probably the most attractive right now because it does have that macro backdrop, helping it relative to other commodities. Debt, that the federal deficit or the debt is really just money printing essentially. That's the money that the federal government has created for the economy to use. And so the question is, are they producing too much of it or too little? I don't see those kind of structural issues right now that would be the kind of tinder for a big collapse or a big problem. It'd be more of kind of a gradual, just losing momentum. Kind of the tailwinds fade, and you get kind of slow growth, and then slower growth, and then maybe you get to a recession.
Sam Burns, founder and chief strategist at Mill Street Research. Would you start by telling us about who you are and how you ended up as a talking head on financial shows like this one?
Well, sure. No, thanks for having me on the show. And yeah, so I've been doing kind of macroeconomic and asset allocation research for a long time, as well as quantitative stock selection work. That's started after I got out of business school in the mid '90s, and has continued on to here. I've worked at different kind of firms, independent research firms, big banks, and things. And then about 8 years ago, decided to start Mill Street Research as my own independent research provider to mostly institutional investors looking for advice on those topics of kind of asset allocation and stock selection globally. And my idea was that having lots of data and indicators and models, kind of objective inputs to my process, and that I can then turn into research for clients, has been the underlying principle there, which is kind of aligns with my view that it's very easy to get distracted by media narratives and kind of what you read in the paper when you're investing, and that having some sort of a solid objective anchor to what you're doing is very important, and that's kind of what I try to provide. But also, of course, looking at things, kind of qualitatively as well, seeing what's going on in the world, and because not everything can be put into a computer and modeled. So I do a lot of that as well, consulting with clients. But yeah, so it's been a kind of a lifelong interest in both macroeconomics and markets, and just finding different ways to kind of analyze them in an objective way.
Okay, let's start with a big macro news piece from last week. And on Thursday, the 14th of March, the Swiss central bank surprised markets by cutting rates. And according to a report by Reuters, this ignited animal spirits as traders realized that major central banks around the world wouldn't necessarily wait for the US Federal Reserve rate cuts before delivering their own. So was that your reading on the situation? And do you think the Bank of England or the ECB could also end up cutting before the Fed at this rate?
It's certainly possible. I think the fact that everyone now knows that the Fed is going to be cutting rates at some point this year kind of opens the door then to give the other central banks a lot more freedom to say, okay, well, whether we cut first or they cut first, we're all kind of be moving kind of generally in the same direction. And there's less worry about a big divergence in interest rates that would cause currencies to then move dramatically. The other thing is that the Swiss inflation rate itself has tended to be lower than the rest of Europe, certainly than the UK. And so they probably have more latitude domestically to do that. And they've been trying to kind of weaken their currency, the Swiss franc, for a long time. And so a rate cut ahead of everyone else would maybe help do that. And it did, I think, bring the euro or the Swiss franc versus the euro down on the news. So I think that there is a bit of a thing that are particular to Switzerland and the Swiss central bank itself that drove that. But it does mean that, yeah, now some of the other central banks, someone's opened the door, they've kind of took in the first step. And so the other central banks can certainly think about it, given that certainly a lot of the economies in Europe are weaker, say, than the US's is, and therefore might consider rate cuts as a response to that more than the Fed might.
So when are you expecting the Fed to cut rates, and how many basis points are you expecting to see them cut by before the end of 2024?
My guess right now is probably, the July maybe meeting is kind of looking like more likely. They've said that they're, expecting to cut rates, but don't want to essentially declare victory on inflation too early, and they want to see the inflation numbers really come down a little bit more and confirm that the trend really is towards 2%. And so I think there's a sort of um, an appearance or kind of a political view of that, that you don't want to start cutting rates before you're pretty certain that inflation is going to get where you want it to go. And the fact that the U.S. economy is holding up even with the high rates that we've gotten right now means they don't have a big incentive to cut rates more aggressively. So I think we'll probably get 2 or maybe 3 rate cuts this year in the second half of this year. My view generally has been, certainly from the standpoint of equities, is that it's less about the timing and the number of rate cuts as it is the fact that the rates are going down rather than up. That the directional shift that happened kind of back in November or so really was the key. And then now it's just kind of, short-term interest rate traders can quibble over the exact timing and everything, but the big picture is that there will be kind of relief on the interest rate front. The Fed realizes that inflation is going down and that there's not really a need to keep rates where they are this high if inflation is going to be close to 2% shortly.
And talking of equities, in a recent blog post, you mentioned that the US market is not as narrow as some might think, and that it's not just the Magnificent Seven that are driving the market's gains, or the Magnificent Six this year, because Tesla seems to have fallen out of the group. But how can that really be the case, though, when my portfolio is flat and everyone else who bought Nvidia and Meta are all laughing at my tiny returns?
Well, I'm certainly not going to speak to your personal portfolio, but it's yeah, it has been a thing in the sense that there's two questions. One, are the large cap and particularly the tech-related large caps outperforming the rest of the market? Yes, they generally have been. That's been true for a while and still is. But are the other stocks, the non, stocks outside of big cap tech, going up? Generally speaking, yes. The equal weighted S&P 500 is doing much better now. Stocks globally have been doing much better now. Other indices are breaking out or hitting new highs. So it's still very much more of a large cap than a small cap move, I would say. But there are a lot more sectors besides tech that are doing well in the U.S., and there are more stocks besides just those few mega caps that are doing well. So there's the sort of the absolute directional move is positive for the majority of stocks. Most stocks are above their moving averages and that kind of thing. But the large cap tech are still doing even better than that. And so the relative performance is still kind of in their favor for the most part. And so, if you're looking at relative performance, you still see that kind of tilt. But it isn't only those stocks going up right now. And so that's a good sign generally for the equity market if there's broader participation. Although, if it gets going too far, if every stock goes up a lot, then that's kind of a warning sign at some point. But at this point, there's still a fair amount of risk appetite, and it is beyond just the big cap techs. European stocks are at new highs, Japanese stocks are at new highs. So it is a more global, broad-based thing than just a few US mega caps.
Would you favor an equal weighted S&P 500 index in this moment? Are you worried about froth in the mega cap tech stocks?
A little bit, or here and there, there's probably certainly some. But in general, my work shows that the earnings trends for those, outperforming stocks are in fact have been and still are stronger than for the average stock, than most of the rest of the stocks. So there is a kind of a fundamental reason why they've done better, that their earnings really are better in terms of the directions the analysts are raising estimates for those stocks much more than they are for other stocks. Now that can go too far. I mean, you can always price in any amount of good news, and so maybe for some of them we're getting to that point. But I think there's also been a long tendency toward favoring large caps in general, not just tech-related large caps, but large caps in general. And that's also visible in Europe as well as in the U.S. And I think part of that is the cyclical kind of phenomenon of when you have rates, having risen, rates relatively high, that hurts smaller caps more than large caps. Most of the large caps don't need to borrow as much money. They're more profitable. They're more diversified. They can access, money more easily from different sources. Small companies typically have a harder time, with borrowing and have, more credit needs. And so in general, I found that that kind of cyclical headwind from interest rates is much more, visible in the smaller companies of any sector, really, almost, than it is for the larger companies. And that's a global phenomenon, but it's particularly, in the US where rates have gone up a lot. And so I think there's a large small cap kind of bias that's cyclical and not specific to technology or something like that. But it's much more dramatic because of those big technology companies. A lot of them, in fact, they have so much cash on their balance sheet for some of them that higher rates actually help them because they don't borrow much money and they locked in rates 2 years, 3 years ago. And so they're actually seeing their profits helped by higher interest rates, whereas most mid-sized and smaller companies, it's the opposite effect. So I think there's definitely a macro influence there, as well as kind of the idiosyncratic outperformance of Nvidia and companies like that have the product du jour, the thing that everybody wants, and that is not that is kind of dominating their sector, things like that. And that's been kind of a thing going on for for many years, where a few companies will have the big thing, and that'll go on for a while, and then eventually they'll competition will do its magic and other things will happen. But for now, I think that there's has been a good case to kind of stay with that trend, both from a kind of just investor behavior following where the momentum is, and also to some degree the fundamentals have supported that. But that won't go on forever, and it has started to become more selective, I think, within technology in the U.S. That even some of the software companies that are smaller that have been doing well, IT services, things like that, have started to see their earnings estimate trends kind of weaken a little bit. And the hardware side has been much more mixed. You have a few big winners and a lot of kind of, companies that aren't doing as well. Intel or Texas Instruments or things like that aren't doing nearly as well as say Nvidia is or something like that. So I think there's a lot more divergences and kind of differentiation going on even within the tech sector than people kind of catch on to sometimes. And so you have to be selective. Yes, you'll have to kind of look for the strong stocks in the strong areas. But I think like I say, there are some fundamental reasons for it, for why that's been happening and are still the case for now, at least.
So if interest rates going up disproportionately hurts small cap stocks, does that mean now that we're moving into a situation where interest rates are coming down, it could be the moment to start pivoting into smaller cap stocks? Because presumably the inverse would be true too, that they would be disproportionately benefiting from interest rate declines.
Yeah, no, definitely. If we do actually see the Fed cut rates, I'm not sure if the kind of anticipation of rate cuts that we've seen so far is enough to really turn the tide for small caps. But I think once you actually do get a few rate cuts and they do see it actually affecting their kind of balance sheets, then you could see more of a tailwind for some small companies. I think there are kind of still cyclical issues of small caps tend to do best when you've had a recession or a market bottom and you're coming out of that kind of very early stages, early cycle in a newly developing upswing, when you tend to get more stimulus as well as kind of just a rebound from a downturn. We're a ways away from that. We've been in an upswing and kind of a good economic and good market environment for quite a while. And so my work tends to focus on where you are in the cycle. And if you're kind of mid or later cycle, you generally don't want to be focused on small caps or overweight them until you start to see the downturn and then the potential, swing back from an upturn or towards an upturn from a recession or a downturn. I think we're still a ways away from that, but it's been a very weird cycle because the post-COVID cycle hasn't followed the normal kind of typical recession expansion cycle that we normally would see, since World War II at least. And so I think you could see small caps pick up, maybe the second half of the year once you start to really see those Fed rate cuts show up. But until then, I think they're going to, still struggle a little bit. And the fact that, a lot of investors still like the kind of liquidity and the safety in some sense of the big cap stocks. You can get in and out of those pretty easily. Small caps, you're taking more kind of liquidity risk. And I think people are still a little bit nervous about going down the chain. But also, like I say, the earnings are just not as strong for small caps. You look at the aggregate for the Russell 2000 or the S&P 600 or globally, and you still see that smaller companies just aren't seeing the same earning strength that the larger companies are across sectors, equal weighted across many stocks. There's still a bias fundamentally toward the large caps. They're just doing better on an earnings basis. So until that really shifts, it's going to be hard to make a big structural case for small caps, but it could come through later this year potentially.
you said that the post-COVID economic cycle hasn't played out as historical precedents might have led us to expect. Could you elaborate a bit more on what you mean by that?
Sure, yeah, and I think it's, winds up being what amounts to a series of different shocks, and then kind of what call a bullwhip effect from each one of them. Because if something goes down a lot, then there's a response, and then it pushes it back up a lot. Whether it's the supply chains or the stimulus from stimulus checks and all that kind of thing, or dramatic rate cuts and quantitative easing, which then has been reversed. China's response to COVID and subsequent effects, then the invasion of Ukraine by Russia and the effect on commodity markets. Those have all been sort of a shock, and then shock waves from that, and then a bullwhip effect when the shock reverses and the response comes. All those things kind of overlapped, and you got this weird series of ups and downs in a very short period of time, and it caused all the data, the economic data, to go way much more volatility than they normally do, which then, of course, threw off policymakers trying to figure out how to respond to that. And that, first you had to have aggressive rate cuts and stimulus after COVID. Then the vaccinations, the vaccines came out, and that reversed everything for a little while. And you had stimulus, and then you had to take that away, and then the invasion and so forth. So all those things compressed what would have been a cycle and had multiple cycles on top of each other for 2 or 3 years. And you also had the fact that because of the way COVID developed, normally in a recession, people cut back on services, cut back on goods. They stopped buying cars and home appliances and things like that. But still, they'll still kind of do they'll go to school and do basic services and get haircuts and things. Whereas in COVID, of course, you couldn't go out and do services, and people just stayed home and bought things. So you had the goods buying going up and online shopping, and then services going down. And then now you've had a reversal of that, and everybody's going out to concerts and going out to eat and traveling and not buying as many goods. And so you've had the reverse of a normal pattern within the economy of the goods versus services kind of cycle, which again has thrown off a lot of the indicators and a lot of the traditional analysis, because just COVID forced all that, which is not the usual pattern. And so and the fact that different parts of the world have responded differently to COVID and the aftermath has also kind of caused other things to happen. So to me, you can't use historical precedents and typical kind of U.S. economic cycles as a blueprint for this cycle as well. And I think a lot of my colleagues, in the investment industry, looking at a strategist to kind of gauge what's likely to happen, have made the mistake of over relying on past cycles and looking at, say, the leading economic indicators, for instance, for the U.S. as an example, have not done well. They've been negative for months and months and months and months now, and we still haven't had a recession. Still don't look like we're going to have a recession, and so it's essentially been wrong because it was set up to measure typical, past cycles, which have much more of a manufacturing, where goods things lead, and you start to, the patterns are based on those kind of historical cycles, and that hasn't been the case. We haven't seen peacetime stimulus the way we saw in 2020 and 2021 ever before. There's just been so many things that have been different this cycle. You can't rely on past cycles to judge it. And so I think that's what's thrown a lot of people off, and why people were so negative coming into, say, 2023 after the kind of slowdown we had in 2022. They were expecting that to continue, and then it didn't. And so a lot of people got wrong-footed and were too bearish, and now we've seen that. But it's also happened the opposite way. The invasion of Ukraine pushed up oil prices and a lot of commodity prices dramatically on the assumption that that would cut off supplies and things like that, and it did for a little while. But then it turned out that there was enough supply, and they just found another way to get where it was going, and commodity prices have all come back down again over the last 2 years. So again, extrapolating from prior cycles, or the OPEC crisis of the 70s, or things like that, just haven't been a good template. And I think that's been the problem with a lot of people when they've tried to make forecasts and do things like that, is over reliance on the past and not looking at kind of the specifics of what's happened, because this has been a unique situation.
And while tech stocks and mega caps have been among the strongest sectors. Um, the weakest have been over the last 6 months or so, defensives and commodity related areas like consumer staples, energy, utilities, and materials. So, does that mean it's a good moment to buy these sectors, or are investors in commodities and defensive just never going to receive an invitation to the party?
Um, Yeah, no, there definitely has been that pattern, and I think again some of that is sort of fundamentally driven. Commodity prices kind of being weak has led to the commodity sectors lagging, and then yeah, the defensive sectors when you're in a high beta market when the economy is doing relatively well, the cyclical kind of more areas are almost always going to outperform, and so even if on an absolute basis they're doing okay, they can't keep up with the strength in other parts of the market. And that's very typical, not at all really surprising in this particular phase of a cycle. So, my guess is that those kind of areas will do better when the cycle turns and risk appetite is not as strong. People aren't chasing the tech stocks or the other kind of cyclical areas as much, and they start to rotate back into the safer stuff. And so, on a relative basis, they should do, relatively better. Um, so yeah, I think it's basically kind of you have to kind of pay attention to the risk appetite cycle, kind of where you are in that cycle. And right now we're clearly sort of in an upswing in the risk appetite cycle, um, and so anything that has less leverage to that is going to generally tend to lag, just from kind of a beta or a exposure to the cycle. And so that's why I think it's important to keep in mind that kind of big picture macro view when people are looking at individual company analysis and trying to think about what's outperformed or what's underperformed and is there a reason for it, both fundamentally in terms of their earnings, and earnings for like utilities or commodity sectors and things like that have been weaker than other sectors. So again, there's a reason for why they've lagged, but also investors are just less interested in those kind of areas because they don't give you the same bang for the buck that the other sectors, the technology or industrials or consumer discretionary things like that might. Excuse me. If if you're in a phase of the cycle where things are going pretty well, you want exposure to the things that are most levered to that.
So, what are some indicators that you would be watching closely to be sort of the starting gun to let you know that now's the moment to start allocating towards defensives and or commodities?
Right, and to some degree, those two can be, can go different ways at times. Um, the commodities will naturally follow the kind of underlying commodity prices themselves. And so if you get into, say, a recession, where demand for everything, including commodities, goes down, then the commodity sectors may not do well, even though they're kind of lower beta or, not as correlated with the overall market, if the demand for the commodity they produce go down. Whereas utilities or staples or things like that will tend to outperform in a more slowdown or recessionary environment because they are lower beta. There's things people are going to buy no matter what. They may not go up a lot in absolute terms, but they will maybe outperform or go down less if the rest of the market is flat to down. Kind of if the risk appetite is much weaker. So I'd first be looking for kind of risk appetite measures. Are the leading high beta stocks starting to kind of crack and roll over and start to lag at some point? That would be the sign that the risk appetite is starting to shift. And that that could happen either after maybe a kind of a blow off of some kind where just everyone gets super optimistic about everything that's high beta and it just kind of cracks on its own, or there's some fundamental development of the the economy gets weaker, or policymakers become much more restrictive. If fiscal policy, for instance, suddenly got a lot tighter, or monetary policy, the Fed changed their mind, decided to raise rates, that might do it. So I think there's those kind of macro events that can cause a shift in the fundamentals that would then push people back toward, okay, the cyclical stuff looks risky now. I want to get into the safer stuff, and that would be the utilities and staples and things like that, healthcare maybe, that would have less exposure to the cyclical risks and more of that safety that people would want. And so, say commodity sectors are different because they tend to be volatile, but they're less correlated with the overall market. So the kind of market beta is relatively low, but their volatility is on the higher side. Whereas utilities and staples tend to be low volatility and therefore kind of lower absolute risk, safer from kind of just a price movement standpoint. And so depending on what kind of thing investors are looking for, um, if commodity prices going up is a cause of the problems in the economy, then yeah, they'll be the ones to benefit from it, and you should go towards them. Early 2008 or something, was an example of that. But otherwise, um, those are maybe if they're cyclically tied, then they're going to be at risk if the overall economy turns down. So I don't see that happening soon, but at some point it will. And that's when you'd want to rotate back towards that. If you start to see risk appetite, um, start to shift, people start buying bonds rather than stocks and low beta stocks rather than high beta stocks. That's when those sectors are going to get the tailwinds back.
I suppose as well, when you're coming at it from a macro cyclical perspective, it's not accurate to talk about commodities as just one homogenous group, right? Because gold behaves very differently from copper throughout the economic cycle. So, my question to you is: are there any commodities that you think are a buy based on where we are in the macro cycle right now?
I mean, certainly the one that shows up strongest, is gold. And in some ways, not only is the price action is kind of broken out of its range and things like that, so that people who are looking at it from a price basis are going to tend to, gravitate toward it. But also, my work and a lot of others shows that when real interest rates start to decline, that's a much better environment for gold in general. That rising real interest rates tend to be a negative headwind for gold, and that falling real interest rates tends to be a tailwind, and we're now starting to see that. At least the real rates certainly in the U.S. have stabilized and starting to pull back a bit. And if the Fed does start to cut rates later this year, that's going to be a tailwind for gold in some ways, just because it reduces the competition for an asset like that doesn't produce income relative to bonds, cash, things like that do produce income. That kind of gap narrows when rates start to come down, and that's a tailwind for gold. You also have, of course, the central bank kind of exposure to it. If some of the other central banks in the world are looking to diversify their holdings relative to the U.S. dollar because of the influence of sanctions and things like that, that helps gold as well, just as a sort of a repository for central banks that don't maybe want quite as much exposure to the dollar. So, for instance, like silver doesn't really have that benefit from the central banks and things, so it hasn't done nearly as well as gold has, even though it's another sort of another precious metal. Yeah, and you're right. Other metals like copper and the industrial metals very much follow a different cycle. There are things that are used in manufacturing and have a productive kind of use, and a lot of that, of course, is driven by China and its demand. I think a lot of commodities like that for the last 30 years, whatever it's been, the incremental demand has come from China globally for the most part. To some degree, maybe India and a few other places, but China has been the real big source of that, and now they've kind of started to reverse in the sense that they're not going to be a source of demand globally the way they used to be. I don't think they're. I mean, I think they'll have ups and downs, but their structural economy shifts mean that it won't be able to push up demand for steel and copper and all those things that they've been using so much of for so many years the way they used to. And so I think that's one of the reasons why you're seeing those kind of metals lag, because there isn't a big demand from the West. Europe is kind of weak, and U.S. is doing fine, but it's not increasing demand for that kind of stuff as much. And because China is relatively weak, you're seeing that kind of downward pressure. And there's for the most part, there's enough of the metals to go around. They find enough to dig up. So to me, yeah, those are very different kind of things. The precious metals tend to benefit people worried about inflation or high interest rates or things like that. That's one kind of reason to buy something, and then the other ones are more just kind of traditional supply and demand, manufacturing, things like that. And same thing to some degree for the energy related commodities. But yeah, so I think gold is probably the most attractive right now because it does have that macro backdrop, helping it relative to other commodities.
Isn't that idea, though, that gold prices rise as real interest rates decline, somewhat contradicted by what we've seen lately? Because the gold price has been very strong, and yet real interest rates have not been declining. In fact, they've been rising, no, because the Fed funds rate has stayed stable while inflation keeps going down.
Um, right. No, yeah, the sort of the effective, I'm just going to pull up, check my numbers here on the real rates. Um, for the Fed funds rate has been going up, as in reported inflation has come down. I guess when I've measured it in the past to do the studies, I've looked at TIPS yields, or the real yields on inflation protection treasury securities, and those kind of peaked around, I guess, October, November last year, and have come down off their peaks. And they're still positive and higher than they were certainly pre-COVID, but the direction has kind of shifted from the steady rise we saw for a lot of 2023 to a kind of a down, or at least flat, stable rate, and it's probably lower than it was 6 months ago now, and that's kind of been the macro variable that I've looked at most closely for gold prices over the last 20 years or so, and found that the rate of gain of gold prices has been much stronger when TIPS yields have been falling rather than when TIPS yields have been rising. So in that case, I think it is more the market's real rates, kind of forward-looking market-driven expectations for real rates, rather than kind of the trailing real rates that are based on Fed policy rates.
Sam, you're kind of like Leonardo DiCaprio in that film, The Revenant, where he has hand to hand combat with a bear. And I say that because your most recent blog post takes on all of the bears out there in the market right now. And one of the most common bearish arguments points to the rising global debt burden. And focusing on the US, the federal debt is $34 trillion, which is over 120% of GDP. And that is an absolutely enormous number. If you think about it per US citizen, it's $100,000 per US citizen. So what's your take on it? How can you dismiss this bear case?
Well, first, I've got to say, I'm pretty certain you're the first person ever to compare me to Leonardo DiCaprio in any way. So I'll take that in any way positively as I can. Um, I hope I don't get eaten by a bear, but but otherwise, yeah, you're right. That part of what I feel like I've been doing for the last at least year or so is kind of pushing back on the big bearish arguments, particularly from a macro standpoint, that have thus far turned out to be wrong, and some of them are more specific to just the current kind of last few months or last year or so, and some of them, like the debt argument, tend to be things that have been argued for a long time. People have been making the idea that the federal deficit or debt is too high for decades, and that there's going to be some sort of collapse or some kind of big problem caused by that. And of course, it hasn't happened. But I think the key point is that big numbers like that look scary by themselves, but you have to put them in context. You have to compare them to the relevant kind of like an asset versus liability, or income versus expenditure. Something has to be put in, because all the numbers about the U.S. economy are big. So you have to compare them as a ratio of some kind, something to make them relevant. And so if you compare the federal debt to GDP, even, or more even particularly to the assets of the U.S. economy, there's like well over 100 trillion of total assets in the U.S. economy. So there's even bigger numbers when you look at the asset side of the balance sheet, rather than just what federal debt is. And so it's actually not that extreme when you kind of take the whole picture, all together. That there's income in terms of taxes and everything, and there's assets that are all there that can support that, what we call the debt. And the other thing, of course, is that for the U.S. federal government, unlike everything else, debt doesn't have the same meaning, because the U.S. federal government, of course, can print its own currency, and is obviously unique in that regard. Nobody else can do that. So there isn't really the same idea of having to repay debt, or that debt doesn't function in the same way for the U.S. federal government, the Treasury, and the Congress, as it does for everybody else in the world, including state and local governments, including companies, households, everybody else. So the idea that the federal government is a household or a company that has to balance its books, or it's going to run out of money, just doesn't apply, and it doesn't apply to any other government that does the same thing. The government of England, Canada, Australia, Japan. I mean, all those countries have the same ability, and so it's just a question of The debt that the federal deficit or the debt is really just, money printing essentially. That's the money that the federal government has created for the economy to use. And so the question is, are they producing too much of it or too little? And both can happen and have happened in the past. You can't have too little money printing, which causes, deflation and potentially depression, or too much, in which case you get high inflation. Um, and so I think to me, there's a big sort of structural misunderstanding in some cases as to what that 34 trillion or whatever it is means, and what its impact would be relative to what if it were the same kind of proportional magnitude for private sector debt. So when I look at like household debt, the aggregate amount that households own, again, relative to income or assets and things like that, that's actually been stable and actually falling a little bit since 2008. And same thing for corporations. They're not excessively leveraged in aggregate to the degree that you would expect to have some kind of crisis. So I think there's a lot of misplaced anxiety about the U.S. federal deficit and debt that really doesn't have the same implications that it would for, if it were kind of applied to the private sector. And in some ways, I think that the deficit spending that we've had the last year or two, particularly, that were driven more by like the kind of infrastructure related spending, the Infrastructure Act, the CHIPS Act, the Inflation Reduction Act, those kind of things that came along in 2021, 22, and are now having their effects on the U.S. economy. Those have actually been one of the big reasons why the U.S. economy has done better than most other economies, and also better than the U.S. economy normally does in this scenario. And that's why higher rates have not crushed the economy the same way that they have in the past. Because normally recessions in the U.S. Tend to happen when the Fed is raising rates and fiscal policy is getting tighter. I mean, they're reducing the deficit, cutting spending, raising taxes. Those are all things that slow the economy. And if you have both monetary and fiscal policy both slowing the economy at the same time, then you can often get a recession. Now we have kind of monetary policy has been tighter, but fiscal policy has been somewhat looser, and those things have now kind of counterbalanced each other to some degree, and that's why you have this kind of relatively good growth, relatively good employment, things like that, without having, but all the while having inflation going down. So I think we found kind of like maybe even stumbled upon a better scenario from a policy standpoint than most people realize or have realized, and that worries about the debt and the deficit are somewhat misplaced, in that you need a certain amount of deficit just to keep the economy going, just to keep up with productivity growth and population growth. And then you need a little bit, to keep the kind of 2% inflation you want. And we're actually not that far from that right now. So to me, the deficit to GDP ratio is the kind of key variable, not the cumulative debt. And the interest expense and all those things people worry about is actually more of a function of interest rates, which is under the control of the Federal Reserve. And so if they lower rates, that'll help reduce that debt, that interest problem, in some ways by itself. And so to me, there is a misunderstanding of kind of how much that matters in terms of a debt crisis kind of a thing, or the dollar. And of course, as you can see, the dollar is holding up quite well. There's been no running away from the dollar, despite the level of debt. And then, of course, the other thing is that Japan has shown us that they have a much higher debt to GDP ratio than we do, but still haven't had any real problems with inflation or crisis. Their currency is weakened, but that's mostly because they've kept interest rates at zero, not because of their debt. Now, their central bank owns about half their debt, so the publicly held amount is much less than the total outstanding. And that's true to some degree for the US. The Fed owns 20-25% of the treasuries right now. And so there's a little bit less of it for the public to hold. But the underlying principle is that federal debt is not the same as everybody else's debt. And it's generally not something to worry about unless the deficit to GDP ratio or something like that shows excessive levels of spending relative to the underlying economy, which would then cause inflation more than anything else. And we're not really seeing that now.
But how about the idea that the government competes with the private sector for capital? So the more it borrows, the more it crowds out more productive business investments.
Right, and that's been a very long-held assumption, and a lot of famous economists have made that argument. I think certainly the last few years, but also in general, the data doesn't really support that. That generally, if the private sector wants to borrow, they can borrow. The banking system and the Fed and everybody else can create credit in however much they want, and that whatever amount the Treasury is issuing from the federal level doesn't really affect that. That interest rates can affect it, which of course is mostly driven by what the Federal Reserve decides they are, and underlying demand for credit or for borrowing to build new factories or whatever is kind of more driven by underlying economic forces, not by what the Treasury is issuing in terms of debt. So, and also, of course, the demand for treasuries is global, not just the U.S. And so a lot of treasuries are held outside the U.S. for reserve purposes and all kinds of things like that, and also held within the banking system, again, for safety reserve purposes, which other debt doesn't qualify for. So there is a sort of a source of demand for treasuries that other sources of debt, private sector debt, doesn't qualify for, essentially. And the private sector can produce whatever amount of debt lending it needs, and generally does, without having to worry about what the Treasury is doing. So there's not really much evidence that the Treasury issuing more debt causes private sector to do less or to invest less. It's whether the private sector sees demand for their products and services as being sufficient to warrant borrowing to build a new factory, hiring more people, the kind of the risk you normally take, the business risk of borrowing money to expand your capacity. They need to see the demand for that. That's what drives the demand for borrowing, not what the Treasury is doing.
And you said that the deficit is what matters. So turning to politics, what do you see happening to the US deficit after the November presidential election in the US? And what could this all mean for investors? How are you positioning yourself in anticipation of this moment?
Yeah, and that's one of the kind of the risks for 2025, I guess, that I think about is, depending on what happens in November, if fiscal policy shifts significantly from kind of where it is now, that would be definitely a risk. I mean, if it becomes tighter, I don't really see a strong likelihood of a lot of new spending programs, kind of big new infrastructure or stimulus or any kind of things that would be way over and above what we kind of see right now. There might be a little more spending on Ukraine or war kind of things, or there might be other things, kind of smaller items like that. But the kind of Infrastructure Act, Inflation Reduction Act, those kind of level of legislation, I think is unlikely, just given the composition of Congress the way it is right now. Now, if the Republicans were to take control of the U.S. Congress in November or the presidency, there's a good chance that fiscal policy might get tighter, and that or that the sort of the spending side would be restricted outside of defense, maybe, but that there might be more attempts to kind of cut taxes for the rich or for large corporations, like happened in 2017. That tends to not be particularly helpful for the economy, because basically you're giving more money to people who have a lower propensity to consume. They're going to spend less of that money. And it didn't really help much back then because the economy was actually doing fine then and didn't need it. And the money wasn't really going where it would be most useful in terms of generating economic activity. So I think there's a lot of, debate, or, you have to think about where the deficit is, but also where it's coming from, or where the money's being spent, or not taxed from, or whatever. The tax cuts for the rich or corporations are different in terms of their economic impact than direct spending or support to households, lower income people, things like that, are all have different economic implications. So, like I say, I think the policies that were put in place for COVID were good in the sense that they responded to COVID well, or as best as anyone could. The more important ones are those kind of infrastructure related ones from a year or two ago. Those, if they stay in place, I mean, they don't get canceled somehow, they'll have kind of lagged impacts for the next few years, I think. And that's, I think, going to be good for the U.S. economy. If they get reversed, or a new Congress starts doing other things to slash spending or things like that, then that would be a risk. If, even if, say, Democrats are in power and decide to raise taxes too aggressively, that could also be a risk to the economy if there's not some other counterbalancing spending. So to me, seeing the deficit to GDP ratio go way down too quickly, in some sort of attempt to, balance the budget, that would be the biggest risk from a fiscal policy standpoint that I would see for 2025 or 26. That'll take a while to happen. That doesn't happen, overnight, but that would be the risk to me. That it's going to be too little fiscal support than too much. I think it'll be the risk going forward.
We've talked about the government debt bear case, but what about consumer debt? Because according to data from the Federal Reserve Bank of New York, US consumers owed $1.13 trillion on their credit cards in the fourth quarter of 2023, compared with $819 billion in the fourth quarter of 2020. Meanwhile, the average annual interest rate on those cards is over 20%, and the delinquency rates have been rising. So do you think it's possible that the strong consumer spending figures that we've been seeing have all just been a debt-fueled illusion?
I think there definitely has been probably more, usage of consumer debt, to some degree. But actually, when you look at the rate of growth of consumer lending from banks, the bank credit stats that the Federal Reserve updates every week and every month, show the growth rate of, total credit, commercial credit, consumer credit. And actually, the growth rate of consumer credit has been coming down and is actually only about 3% year over year now, I think, which is below where it was even pre-COVID. Kind of 5%-ish is sort of typical for that rate. So I think the actual growth rate of total consumer credit, whether it's credit cards, auto loans, all those kind of things, has actually been falling and is actually quite low. So overall, I don't see the credit exposure of the consumer being a big concern. And yeah, obviously the Fed raising rates causes credit card, interest rates to go up a lot, and they have. And so the amount of interest paid and therefore probably the balances on some of those credit cards in that specific category have gone up. Again, that will maybe be helped if the Fed does cut rates later this year. But also, I think there's a certain percentage of that. I can't remember what the percentage is, but it's pretty high, maybe 40%, that are basically non-interest-bearing balances, people that pay off their credit card at the end of every month. So that they're basically just kind of playing the float, essentially. They get a 30-day loan from your credit card company for free. That's also growing. And the fact that total income has been growing all this time means that the capacity to pay it has grown to some degree alongside it. The other thing, of course, is that higher interest rates mean that people who have, interest-bearing assets, bank accounts or treasury bonds or anything, are seeing more interest income. So again, there's an income side of it that's gone up as well, in addition to the kind of interest expense side. And maybe there's a little more interest expense than there is interest income, and different people have those. So maybe lower income people have to spend it on their credit cards, and higher income people are just getting more income on the treasury bonds or their bank accounts, money market funds. So they're not the same people always, but in aggregate, there's a balance there. So the net interest income of the economy is still positive and has only come down sort of moderately from the data I look at. So again, you have to put those numbers in context of what is if the interest expense has gone up, has there some income that's also gone up, and have the assets gone up to support it, and is that driven by convenience of using a credit card that you're not paying interest on versus actually borrowing money to fund your day-to-day expenses. But again, the overall growth rate of consumer credit is actually relatively low. And as is the case for credit in general, commercial lending or borrowing is also relatively low growth rate now. So it's not just consumers. So that's one of the reasons why I don't think credit is a big problem for the consumer or corporations, and why I think the Fed is looking at that as a reason to support cutting rates. That inflation usually goes up when bank credit is rising aggressively. If you have 10-12% growth in credit, that's maybe an inflation worry as well as maybe a balance sheet issue. We're not seeing that now. In fact, it's more the opposite.
So you've batted away all of these bear arguments, from massive government debt to consumer spending just being driven by credit card happy spending, and also the idea that the S&P 500 is just being propped up by these magnificent seven tech stocks. So I'm coming away with the idea that you're in general quite positive. And that brings me to my next question about recession. I'm assuming you don't see a recession happening in this year. What about in 2025 in the US?
No, you're right. I think I'm generally been more positive than some of my, colleagues in the industry. I think like I say, the big kind of lopsided thing that's happened over the last 12 to 15 months has been that more people have been too negative than too positive. Now that's starting to shift. There's definitely a lot more optimism in the market. There are higher valuations on stocks than there have been for a while. So, the kind of idea that expectations are low and easy to beat was the case last year, but really isn't the case so much now. I don't think expectations are excessively high, but they're definitely closer to kind of where they should be, or kind of normal rates, and maybe starting to get a little high in some areas. So to the extent that markets do best when the news is better than expected, even if it's not that good, as long as it's better than expected, that still makes the market go up. And that's what happened, since late 2022. We're kind of getting past some of that now. And now it's going to rely on actually the fundamentals continuing to improve, or at least stay stable, to kind of keep things going the way they're going. But yeah, no, I do not see a recession this year. I think we've got enough economic momentum to kind of carry forward for a while. And the fact that the Fed seems to be moving in the direction of, loosening policy rather than tightening. And the risk is, yeah, that the Fed kind of winds up kind of keeping rates too high too long, and that has lag effects. So that 6 months, a year down the road, that all starts to kind of pile up, and then you start to see a slowdown from that, or fiscal policy shifts and becomes tighter. That would be a risk for a recession, maybe next year. The other thing, of course, is just that cycles don't go on forever, or there's some other shock. Maybe it's not something as big as COVID, but certainly a big slowdown in China, some other kind of war, disruption, military actions somewhere in the world. That's obviously going to be very disruptive. Um, Anything like that that's kind of an external event, beyond just kind of the domestic U.S. economic kind of policies, is always a risk. And we certainly, of course, seen plenty of that in the last few years. But I'm looking more at things like that than in domestic imbalances, the way you might have seen, say, in 2006, 2007, where those kind of, the banking system, the mortgage, market, all those kind of things were clearly much more distorted and kind of skewed, and excessive leverage, all those kind of things that set up a problem. And then it's just a matter of what would set it off. I don't see those kind of structural issues right now, that would be the kind of tinder for a big collapse or a big problem. It'd be more of kind of a gradual, just losing momentum, kind of the tailwinds fade, and you get kind of slow growth and then slower growth, and then maybe you get to a recession if something else goes wrong, or policymakers make a mistake. Essentially, they over tighten, or they over regulate, or they do something like that. That's certainly a risk in Europe, where regulation on the technology sector is much higher now. They don't have Apple and Microsoft and Google and Nvidia over there, in part because their economy doesn't really support it as well, and their regulatory structure doesn't support it as well. So the fact that we have these big tech titans, has helped our stock market, but also our economy, in a lot of ways that other countries don't have. Canada doesn't have it. Europe doesn't really have it. UK. And so you can see that in the underlying economic data. You can see it in the stock market. And so I think, to the extent that those benefits continue to kind of go on, that'll help. But you have to have the policy backdrop to support it. And so, too tight monetary policy or too tight fiscal policy, those are usually the things that precede recessions in the U.S. And so until I see more of that, I'm going to be less worried. Yeah.
Outside of the US, the Japanese Nikkei 225 has blown past all-time highs, returning 50% over the last 12 months. So would you be a long-term investor in Japan right now, despite the Bank of Japan inflicting a massive hike last week from a minus 0.1% to a range of 0 to 0.1%?
Yeah, no, it was interesting that, the kind of news about the Bank of Japan's policy shift, um, made it clear that it was a significant shift in the sense that it changes the framework that they're using, but it also, yeah, it was less than a quarter point really of a rate hike, and only kind of technically moved it positive from negative. And that's why I think the yen didn't rally and the stock market still goes up, and it's not a real tightening of policy relative to anything else that's going on in the world. Um, but yeah, I think the Japanese economy does have some tailwinds now. Certainly, when I look at the earnings estimate trends from kind of the individual companies in Japan, kind of an aggregate, which is a lot of what I look at from a kind of a regional equity allocation standpoint, they've been much stronger than the rest of the world. So there is fundamentally the earnings in Japan are much stronger than most of the rest of the world right now. So there's a good reason for them to be doing well, in addition to the fact that their monetary policy is, still much easier than everywhere else in the world, despite their little rate hike. Um, so I think there are good reasons. There have also been some structural issues of, the government trying to force Japanese companies to become more shareholder friendly, to kind of unlock some of the money that they're sitting on in their balance sheets, and to, be more active in helping, distribute it to shareholders, things like that. Because the Japanese kind of corporate structure has been a lot different than the rest of the world. They tend to be more kind of restrictive in what they do, and a lot of not as shareholder friendly in some senses. And so if that's shifting, that could be a structural reason why Japanese companies will look better than other countries. So I tend to look at things on kind of look out 3 to 6 months and see how things look, and then every few months update your view just to see how things evolve, rather than making a big 5 year pronouncement. But yeah, I still see positive trends in Japan. I think the breakout, certainly kind of clears the way from the standpoint of the stock market and technical indicators and all that kind of thing. And I think there are kind of structural issues that are being, worked on there. And the fact that the Bank of Japan is comfortable with the idea of saying, we're not really fighting deflation as much anymore. We're going to kind of manage inflation and get to something closer to what a normal central bank policy would be, having positive interest rates and kind of saying, that inflation should be low, but around 2% or something. That's what kind of normal sort of scenario would be, as opposed to this long-term trend that they've had of trying to just stave off deflation by any means necessary. I think that shift is a good sign, and the fact that they can let their currency weaken as they have, which helps their exporters a lot, and not really worry about it too much, in the sense that they can handle that. Whereas China, for instance, does not want to let their currency weaken anywhere near as much as, say, Japan has let the yen weaken, because they're worried about capital outflows and other things like that. Japan, a much more open market, and doesn't have to worry about that as much. So that's why I think there's been a lot of money shifting out of China and some of the other areas that are exposed to China, like Korea, and moving towards Japan, which has a little bit better structural tailwinds right now.
Getting into more of a kind of theoretical, getting into the weeds a little bit here. Is it necessarily a problem to have deflation in your economy? Because I know the traditional argument is that if the price level keeps going down, then people will put off buying things because they know that their money will go further if they wait, and so therefore aggregate demand falls. But I recently interviewed an economist from the Austrian school called Robert Murphy, who's a fellow at the Mises Institute in Alabama. And he pushed back against that argument, and he said, well, what about technology? Because if you look at computers, for example, they just get cheaper and cheaper when you think compared to the amount of abilities that they have. And yet nobody says, oh, I'm not going to buy a new laptop this year because I want to get something better for the same amount of money next year. So how would you respond to that idea that deflation maybe is a bit of a boogeyman?
Yeah, no, there's definitely kind of multiple arguments about deflation in general, and then deflation in specific segments of the economy, like technology. And technology is one where there's been essentially deflation for decades, or even, if you want to expand the definition of technology hundreds of years since the Industrial Revolution, arguably. Um, but I guess there's a difference between deflation in certain segments of the economy versus economy-wide deflation, where everything is going down. Um, and that's a little more, I think, risky in the sense that, yeah, it can cause people to think about whether they want to spend their money now, but also the fact that debt has, fixed rate, fixed payment schedules, things like that, means that borrowing and borrowing money at fixed positive rates is riskier. And because debt kind of has a breaking point or whatever. If you can't pay your debts, then you default, and then bad things happen. That means that deflation makes it harder to pay back debts in aggregate again, if the whole economy is deflating as opposed to just certain sectors. And if the deflation comes in terms of absolute price level versus like you get more for your money. So a computer, still costs whatever it costs. You spend $1,000 on a computer, you get a better computer, but not that you're spending $100 on a computer, in an absolute sense. So I think that also makes a difference. But the fact that some things go down in price, like technology, but other things like education or healthcare, that are more reliant on things that are harder to, use economies of scale for instance, those tend to get relatively more expensive. So that overall in the economy, you don't have deflation, even if some sectors or some products do have deflation. So there's definitely a long-term trend that goods, and particularly technology-related goods, get cheaper. Other things don't. And so on average, you don't have aggregate, economy-wide deflation. There's also, of course, population-related stuff that, in Japan, for instance, the population is declining. So you'd expect some deflation, lack of demand just from that. There's just fewer people to buy things, and they're getting older. So they buy different things when you get older. So demographic shifts can definitely affect price trends in aggregate. And if there are fewer people and they're getting older, you might expect deflationary forces from that alone, in addition to technology. So technology, yeah, is very much a disinflationary force over time. And in fact, in some respects, that's why you need at least a certain amount of money printing by the government effectively to counteract that. Because if you had, say, a balanced budget in the U.S. federal deficit, and we're basically not printing any money, and there was economic or technological progress, productivity, then you would have deflation because there'd be more stuff and not as many dollars to kind of go around, and so the price level would fall, and that's risky from the standpoint of debt and for people trying to make predictions about the future and growth. So inflation is bad because it's hard to project in the future if you're uncertain about what the costs are and the revenues are going to be. The same is true for deflation if it gets out of hand. And that's the problem, is that people assume, or the risk is that a little deflation is okay, but it can spiral into too much deflation in the same way that inflation can spiral. If you try to produce policies that produce inflation, you might get more than you wanted. Same thing for deflation. If you pursue policies that encourage deflation, you might get more than you really want to. And then you get a depression essentially, and you get bank failures and debt problems and all those things that happened, in the past, particularly when we were on the gold standard. So I think that's one of those things you want to think about in terms of balanced risks. Too much deflation is bad, too much inflation is bad. You want to be in the middle and allow for the fact that technology does tend to push prices down naturally, but not for everything all at once. So yeah, your computer will get cheaper, but your healthcare might not. So in aggregate, the spending shifts around within the economy, but doesn't deflate the whole economy. And that's kind of the way it naturally works. And so and that's why you want the deficit, in the U.S., for instance, to be, a sort of a positive number, in the sense that you need some deficit to create the money to offset the deflation that would come from technology in some sense. Most people don't think about it that way, and that's a slightly counterintuitive in some senses. But I think that kind of addresses the idea of deflation is not necessarily bad unless it gets out of hand, and it will tend to happen naturally if there's technological progress and productivity, which is good. But you want to balance it out and make sure that it doesn't cause problems for the debt and for people to be able to plan things.
As much as it pains me to shift onto this topic. Bitcoin is now above its pandemic era highs, reaching nearly $74,000 earlier this month. So, does that mean that Bitcoin and cryptocurrencies aren't just the Beanie Baby or tulip mania type bubble inflated by loose monetary policy after all? And are you looking to include crypto in your asset allocation decisions now that it's easier to get access through these ETFs?
Yeah, it's been interesting to watch the whole path and development of Bitcoin and specifically and cryptocurrencies in general. Um, and you know, from a my Mill Street Research business standpoint, I kind of go with what the clients ask for. Most of my clients are still more kind of traditional financial asset, portfolio managers. Most of them, their mandate does not allow them to invest in Bitcoin at this point, whether they want to or not. So I haven't really gotten demand from the clients that I have now to kind of give opinions about Bitcoin or to include it in my asset allocation. Um, and part of that is because, again, just regulatory things take a long time to kind of evolve for the investment management industry. But also because in the same way that I felt like I don't always have a good handle on, say, gold, for instance, in terms of how to analyze it, certainly in the short term. Like I say, real rates are a factor, the dollar is a factor. I know kind of some general macro factors that tend to influence gold, but I don't feel like there's a lot of kind of that, animal spirits and things like that, or things like central bank policy decisions that are hard to predict or model, that I don't, feel like I have a good enough handle on where I can make strong predictions and kind of work it into my asset allocation. The same is true for Bitcoin in that because they're not cash flows and things like that that you would kind of associate with traditional investments like stocks or bonds. The framework for analyzing, asked me to tell you why Bitcoin is going to go up or down. Yeah, it's either going to be kind of a general supply demand thing like that. Well, more people can buy it, they probably will, so it'll go up. But what is it worth? How would you put a value on it? I don't have a good framework for that, just to be honest. And so I would be cautious about making bold statements about which direction it's going to go. But it is clearly tied to risk appetite. So if people are buying, high beta stocks, whether it, and that's the other thing I guess I should point out as a side point, risk appetite and the demand for high risk things, whether it's a Bitcoin or Nvidia or whatever, is not necessarily as tied to interest rates and easy money as people think. As you remember, the late 1990s, interest rates were as high or higher than they are now and were rising, but you still had a bubble. You still had the massive tech stock explosion and then the crash. That was not because interest rates were zero. So the tie between zero interest rates and easy money and speculative enthusiasm is much weaker than people think it is. We've now had multiple instances where people are perfectly happy to buy speculative stocks or cryptocurrency without having zero rates. So I don't think that's the reason why Bitcoin has done well in the past or now. I think it's just speculative enthusiasm in a lot of ways, and yeah, just growing sort of ability to buy it. But also, I think there's the fact that part of what cryptocurrencies and Bitcoin kind of capture is demand for being able to move money around globally outside of the traditional, ways of doing it in banks and kind of under the traditional government control. So to me, that's a thing that's hard to measure and predict, but clearly there's some demand for being able to move money around, without having the government control it as directly. And particularly if you're in parts of the world where you can't do what you want with your money, whether it's Iran or Russia or China or Venezuela or, places where they very much restrict what you can and can't do with your money, on alternative cryptocurrencies may really have value. And even the volatility of Bitcoin or cryptocurrencies may be a risk worth taking if the alternative is confiscation or wild volatility in the Argentinian currency or things like that. Then yeah, there may be a value for that. For someone like me who's a law-abiding, tax-paying U.S. Citizen who can use U.S. dollars for everything I want to do, that doesn't really apply as much as a use case. because it's very volatile. You can't really buy anything in Bitcoin at the grocery store or anything like that. So it's more of either a speculative vehicle or a play on demand for traditional kind of banking or money transfer services. And again, I don't have a good way of telling you what that's going to look like a year from now. Um, so the other thing, of course, is that maybe Bitcoin has a restricted amount of supply, but cryptocurrencies in general do not. There's a million of them around. There's always another one coming along. Some of the other big ones don't necessarily have the same restrictions. There's a lot of issues with kind of using them as a currency. There's a lot of costs and risks involved. There's been a lot of fraud and scams involved. So to the extent that that starts to clear up, or get better, yeah, that'll help. But again, that's not something I can analyze of knowing, well, are there going to be more frauds or less frauds, in the cryptocurrency space than there have been? I don't know. I hope not, but I mean, I hope that there will be fewer. But um, that's again a structural reason why a lot of people are nervous about the space, is that they're, aside from Bitcoin trading on the exchanges now, a lot of the rest of it is still highly speculative and volatile. And so kind of the big traditional slow moving asset managers in the world are going to be slow to move that direction.
I've always personally been in the Peter Schiff camp of thinking that it's just a crazy Ponzi scheme that's headed for zero, but I've been consistently wrong on that call. Anyway, I'd like to introduce to the listeners a new segment of the show called the Resource Talks $1 million Portfolio. And the premise is simple. I have $1 million in a dummy portfolio, and I'm going to be asking each of my expert guests to make a single buy decision, and then we'll check in each episode to see how it's going. So it could be a too many cooks spoil the broth type thing, or it could be a many minds are better than one type result. So Sam, my portfolio today is completely empty with just $1 million in cash, and you can make only one buy decision, and you can use as much or as little of that 1 million as you like. So what decision would you make?
Um, One decision.
Here it is on the screen. So you can see here's my empty portfolio. I've got $1 million in cash, and I haven't got anything in there yet. So
Okay, okay,
but
okay.
you're not going to be the only person to contribute. So you could invest all 1 million now if you want, and then subsequent guests can make decisions to sell, or you could just say, "Well, I'm just going to invest a small percentage." But make a decision, and then you can put in a sell rule as well. So you can say, "Oh, well, if it goes below this price level, or if it goes above this price level, sell it." Or if there's a US recession, then sell it. But it's got to be very specific sell decision rules so that I'm not making the decision. And you can sort of, in that way, leave behind instructions.
Yeah, I'm trying to think whether I want to go for a specific sector or industry or just leave it as a broad market
Go an
um,
ETF if you want, whatever.
ETF kind of thing. Yeah,
Yeah.
something like that. Yeah, I probably wouldn't try to pick an individual stock just because that's too idiosyncratic. But um, yeah, um, well, and I guess yeah, is it? And this is sort of, I guess, a long only position, meaning not a long short. Is that
Yeah,
your,
just
your
long only,
long
exactly.
only? Okay, yeah, yeah. And yeah, I mean, as boring as it sounds, I would probably now, given where my models are lined up, have to say, the SPY, S&P 500 is the simplest and
Right.
easiest thing to be long. Um, because not only do I think the stock market in general globally still has, a bullish scenario, I think the US is going to keep outperforming the rest of the world. Um, the other pick I would have would be Japan. Um, but um, but yeah,
What
I mean,
what's the what price is it is the
yeah.
SPY at right now?
So yeah, so well, yeah, the kind of typical benchmark for an institutional investor would be, 60% stocks, 40% bonds is kind of the benchmark. So I would be above that. So for the purposes of your model portfolio, then you probably should just say 100% stocks,
So
SPY.
you're going to spend all $1 million right now, then?
Yeah, yeah.
Okay, right. We'll see if
I guess, well,
future
how
guests
often do
want
I get
to.
to come and change this?
Well, you can leave a sell decision for me based on a relevant
Okay.
indicator,
Okay.
the
Um,
purchase price. Well,
yeah. Um, so yeah, no, I mean, assuming, yeah, um, we could be hold it for a while and only change it, something changes. Um, so the sell rule, let's see, I would probably just, I'm gonna keep it simple here. Um, say that if the S&P 500 breaks its 200-day moving average, then yeah, it'd be time to get out.
did you say 200-day moving average?
Yeah.
Okay.
Um,
Sell all of it if that happens.
I mean, if we could make a rule, it could probably sell 50% if it crosses the 100-day moving average, and then the rest if it crosses the 200-day moving average. So you'd have a sell half and then sell the other half.
Right. Okay.
Would
So
be kind of the, one to make it a little more realistic as to what you'd actually do. And normally I
sure.
wouldn't be all in or all out like that, but um, since I don't know if I'll have uh, a chance to update the view in real time, over the next few months. If something does change, then that would probably be the rule I would put in. Um, so yeah, if the S&P is around 5,200 now, the 100-day moving average is currently 4,800. The 200-day is at 4,600. Obviously, those will change. Those will probably keep going up for a while as the market goes up. But that's probably the rule I would use: half at the 100-day and half at the 200-day.
Excellent. Thank you very much for your input to our $1 million portfolio. And I can guarantee you that our next guest will probably be an extreme bear or gold bug who will probably want to undo some of what you've done. But that's part of the
Well, no,
too many
that's
cooks
good.
spoil
Yes,
the
that
broth,
way,
isn't
yeah,
it?
it won't be all of us saying the same thing.
Yeah, exactly. Yeah. So, Sam, it's been a great conversation. Thanks again for coming on the show. Is there anything that I haven't asked you about that you'd like to mention before we wrap up?
No, I mean, I think, big picture, I think is a lot of the stuff we talked about. I think my advice to people in general is be careful about getting swayed by media narratives and particularly bearish media narratives because they tend to sell better. I think a lot of people have gotten on the wrong side of things in different markets for a while now because of that. It's much more exciting and fun and sounds smart to make big bearish cases a lot of times, but doesn't always pay off well. And so, be very careful about that. Look carefully at the data and put things in context. Otherwise, yeah, go to millstreetresearch.com. Check out the work I do there, the blogs that you found there. I think, sounds like they've been helpful for you in getting a feel for what I do and how I think. There's a Twitter account that I post to pretty often at Mill Street Research. You can follow also on LinkedIn. There's a company page there where I'll post things. So if people are interested in following more about it, they certainly can find more there.